that's an important thing to remember, that the private equity companies, the operating companies, sometimes those private companies can be just as big as the public company, but they just happen to be privately financed. They never felt the need to register their securities on the, in the public markets. Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time.
Welcome everyone to Alt Investing Made Easy. Today we're taking a deep dive into the subject matter we covered in our first episode, Intro to Alternative Assets. We will do a series of 5 deep dives into each of the 5 topics we covered when we first started this webcast. We hope you find this level of detail useful and interesting.
Well, thanks, Sarah. Yeah, I think it's just so important for us to make sure that we're not using terms casually in a way that our audience members maybe, they've heard the term. We're going to start with talking about what a security is today. Maybe you've heard that term before, but where did it come from? And maybe clearing up misconceptions, and to the extent that we can make the definitions more clear, maybe it gives investors greater confidence to invest in something like a private security that has different characteristics, different considerations than public securities, for sure. But we're going to start today with the definition of security from a Supreme Court case called Howey. Howey was one of the litigants in that, and the case was analyzing whether a particular investment contract constituted a security, and the Supreme Court articulated a specific test for how you tell whether an investment contract is a security. And I'm just going to read out these components, and then we're going to kind of talk through each one individually. But first of all, we're talking here about investment. So the first aspect of this is that there was an investment of money. Somebody paid money over from one person to another. And then it's an investment in a common enterprise, so that common enterprise concept. And then it's, of course, with the expectation of profit. So that's an important consideration. And then the profit won't be derived from the investor's efforts, but it will be derived from the business efforts of other people. So the distinction here is between ownership and management.
Exactly, Roland. And for example, of an investment contract, an example is a partnership agreement or a company agreement for a limited liability company, which is also called an operating agreement. And so these are actually the agreements that set out the investment contract that then can be assessed to determine if these other components are present.
Right. The investment contract, it sets forth the terms and conditions of the investment. It's a contract between the investor and the company, and it'll define how the investor is going to get their money back and whether they have any rights with respect to the investment.
Mm-hmm. This is exactly where the topic of the portion of the test that's discusses the investment of money. But then in terms of the common enterprise, what are some examples, do you think, of what a common enterprise is?
Yeah, I really like that term. And the idea in my mind when I think about it is a bunch of people coming together to form a partnership. They're all contributing capital to this enterprise, a company. The enterprise relates to the actual business concept. You hear the term enterprise value sometimes. So it's just the value of the company that you're investing in. But the common enterprise, when you have a bunch of owners, a diverse ownership group, 30 people own the company or whatever, or you could have a company with thousands of shareholders, but they all hold that ownership in common together. And it's, ownership in a common enterprise.
Right, which can be as much as 2 people all the way up to, like you say, many, many. So then, of course, there's an expectation of profit because in the end, this is business. And there's a whole other area of the law where we can discuss companies that don't have the expectation of profit. But in this context of securities, we're almost always talking about the expectation of profit.
Yeah. And then I really think the last one is the one that people should get their mind around. The profits aren't going to be derived from my efforts. I mean, I'm just handing over money to the management of the company, and I'm relying on management to go and take that money and make the profits, but I'm not going to contribute really necessarily to the day-to-day management of the enterprise. I'm going to be deriving the money that I make off the appreciation from the securities or from the income that the securities pay out, like as dividends. I'm going to be getting those things from the efforts of other people. So ideally, it's money while I sleep.
Exactly, which is, in the broader context of wealth building that we talk about on this webcast, an important component. So, all right. Well, I think that essentially, again, is a deep dive into the meaning of a security. So now that we've defined security, Roland, what are the types of securities?
Yeah, and there's one big distinction in the 2 types that I think we should emphasize here in kind of talking about first principles are public securities and private securities. And I think that most people, when they think about securities, they're thinking about public securities. I'm going to go log in to my online brokerage account and buy a share of Microsoft. And that Microsoft, the common shares of common stock that are freely tradable, are registered securities. They're publicly traded securities. And that for sure is a security. But we really deal more with private securities, and we're focused specifically on private securities for alt investing made easy.
Exactly. And I guess another key point with public securities to keep emphasizing, because we'll talk about it later too, is a public security is part of a market and it's subject to market forces. It has certain liquidity resulting from that, and it's also something that's trading on a regular basis, usually if it's a big enough public security or public company. And those are some important distinctions we'll talk about later. And then again, with the private securities, in terms of any special characteristics, what would you say those are, Roland?
Well, people should understand that the general rule is that all securities must be public. So they must be registered. There must be a registration statement in effect. You file the registration statement with the SEC, and being a public company is really expensive. That whole process, the registration statement process for an IPO is very, several $1 million in legal fees by itself. But thankfully for American small business, such a huge portion of the American business market is financed through private securities deals, and there are exemptions from those registration rules that we deal with. The most commonly used one for about 95% of all private securities offerings is Reg D, and most people have heard of Reg D. I'm going to do a Regulation D offering,
right.
Rule 506. Rule 506 is a specific rule number under Regulation D, and Regulation D is a regulation that's issued or administered by the Securities and Exchange Commission under the major U.S. federal securities law, which is the Securities Act of 1933.
Exactly. And some common types of private securities that we focus on here, actually on alt investing made easy, are investments in, membership interests in LLCs that then conduct commercial real estate business. You can also have membership in partnerships or LLCs that are more private equity investments or businesses. We also have hedge funds, right? But we'll talk about those main categories of private securities in a little bit.
And you mentioned it before, the main thing that people should understand when they're investing in private securities, and I think this comes up maybe a little bit further down, but just the liquidity idea that with the public securities every day, if you don't feel like investment in Microsoft is the right one and you want to go invest in Apple, you can log in today and sell that share of Microsoft. But with the private securities, frequently that liquidity is not available in the same way.
Exactly. So then just to close out this section on key terms, just for the basic introduction to alternative investing, what's an accredited investor, Roland?
Well, that's a great question, Sarah, because the exemptions that I mentioned before, the registration exemptions require that almost uniformly the private securities can only be sold to a class of investor known as accredited investor. And there's a specific definition of that, but you can think of it as anybody that has a net worth of $1 million exclusive of the value of their personal residence, or income of $200,000 per year, or $300,000 with their spouse. So primarily when we're talking about private securities, these are investment opportunities for wealthier people.
Exactly. And there are reasons for that we've gone into in other episodes. And I think we'll have a chance in this series on deep dives that we're doing to get more detailed about why accredited investor standards do make sense in the big picture. So then to close this out, shall we move on to an overview of private securities and the main categories of private securities, Roland?
Yeah. So I guess, are we thinking when we say the categories, I mean, we mentioned before that we've got, you could have shares of common stock, you could have LLC interests in a limited liability company, or partnership interests in a partnership. Those are the different entity types, but they're all, any business really can be owned and operated through any of those types. And then the division is, the public versus private securities. Is that, are we covering what we need to there?
I think so. I think maybe what we could do is, we've talked about how these different definitions. So then again, if we focus on private securities, they're different classes of these assets, right? So there are these different ways that you can have a private security, but they apply to each class of type of private security, maybe you could say.
I see what you're saying. So
yeah.
So then when we have these classes of private securities that we're talking about, you can further divide the types of enterprises, again, that you're going to be investing in. The three main categories of private securities investments are investments in private equity,
Right.
investments in hedge funds, and investments in real estate.
Right. So remember when we first did the intro, we actually had an interesting discussion about contrasting those classes or categories of the types of investments that you can do as a private security. And we contrasted them with the traditional investments. So for example, if you want to talk about the investment in a public stock or public equity versus private equity.
Yeah, I've got a great example there. GE is a public company stock. I guess they're still around. But I was just thinking of, a company that's known for manufacturing of electric motors. So whoever that would be, but that, let's just say GE for now. But for a long time, I represented a company that had an innovative design for an electric motor, and they were a private company. And they financed their operations through the sale of preferred stock through a few rounds of sales of preferred stock. It was Series A through C. I worked with them on, and those were all private deals, and they were issued under these same registration exemptions that I was mentioning before. And that was a private company. The common enterprise there was a company that was trying to commercialize an innovative design for an electric motor. So in a similar business to what the public company was in, but it was just on a different scale.
Right.
Usually the public companies are much bigger, and so they can absorb those legal costs of registering their securities and having those ongoing compliance needs.
Exactly.
And typically with the private equity company, they're smaller. But that's an important thing to remember, that the private equity companies, the operating companies, sometimes those private companies can be just as big as the public company, but they just happen to be privately financed. They never felt the need to register their securities on the, in the public markets.
Exactly. And it's actually an ongoing trend today. They say that, more and more there are these large private businesses that are, probably have components of different aspects of private investments. But in the end, because there's available investment capital to then that kind of eliminates the need for the public markets. But the American economy is so large that, in fact, I think as an investor, we have many choices in both categories. Which is good for investors, really. So.
Yeah. The opportunities. We really have a robust market for all the public investments, and then it's harder to uncover the private deals. You can't just log into your online brokerage account and look at some. There are some private deals that are listed, maybe, but by and large, you're going to be just looking at those public companies.
Exactly.
And one thing we haven't talked about that came up is, just understanding that we primarily deal with people that are selling equities, but securities can be debt securities as well. And
that's such a good point. Yeah.
So the debt is more of there's a specific definition. Let's see if I can remember it. It's a fixed amount of money with fixed repayment terms. There's a defined term, a time term related to the debt, and then fixed interest, or it could be variable interest as well, but a fixed amount return. It's not going to be the same return profile as an equity investment where the growth potential could be huge. With the debt, you're going to be generally capped out at maybe usury limit. So it's a fixed amount of money that you're investing, but you get a fixed return. So, I'm going to invest $1,000 today, and like a CD is a great example of that. In 12 months, I'll get $1,050.
Right.
If I make, is that right?
It's not too far off from that anymore, I think. Yeah.
So, but we wind up talking more about equities generally.
Exactly. And I do think, though, in another episode, maybe we could, revisit some of the details of the private credit market, because there is a whole series of terminology and things that we know from commercial real estate, at least, that where the private credit market is really thriving. On perhaps one could say on a smaller scale than what you might see with the big banks and the big bond issuances, et cetera. So
yeah, for sure. Well, that gets us into real estate. So there are things called real estate investment trusts, and they're public entities, they're corporations, and there are specific requirements about how they must distribute a certain portion of their revenues every year in order to qualify for some special tax rules. Those are public entities again, and they're investing in real estate, commercial real estate. It could be any kind of commercial real estate, multifamily property, self-storage, industrial, office, all the different types. But then, we really work a lot with private real estate deals. And so that could just be we form a Texas LLC, and they go out and get a 200 unit apartment complex under contract, and the sales price is $10 million.
Right.
That's going to be much smaller investment than what you'll have in the public REITs, but it may be that a public REIT invests in 100 properties like that, and we help finance the one with the private securities deal.
Exactly. And I guess there are different reasons people prefer that, and one of them might be the more personal contact and different reasons like that. But which kind of brings us to talking about a couple of main differences between, as we've talked about above as well, the private securities and public securities, is the liquidity differences. And this is a really key factor that we keep mentioning because it's so important for investors in private securities to understand that their investments are not very liquid, if at all, and are dependent then on exit based on the terms of their investment contract or otherwise other things that might happen.
Yeah, the relationship between the liquidity terms and how readily sellable the underlying asset is really key, and maybe nowhere better. You can understand it better than with the private equity. I was just thinking that when I invest in a private company, the goal is for that private company, the private operating company. The liquidity goal is, the liquidity event is when the company gets sold or when they do an IPO.
Right.
But it really could be that you're just a shareholder in a private company for an indefinite period. If they never are acquired by a public company that has freely tradable shares, or if they never conduct an IPO, then there is no real liquidity option unless the company initiates a buyback plan or they permit you to sell through a private sale to a third party, which does happen from time to time.
Yeah, and you know what, Roland, I used to have a little bit of a joke because I worked in private equity. And when I worked for this specific company, it had a number of private equity investments in some pretty large businesses, but it was right at a time that the economy took a real downturn. And so the exit plans weren't executable, you could say. And so very quickly, that private equity company turned into an asset management company because it ended up holding its investments, double the time of the exit plans. And so it was a different kind of approach that you have to take when you're involved with a business for so long, when you're basically a private equity fund. So it was a really interesting experience to watch all that up front. And it is true that you have to turn to other exit strategies when the original plan isn't possible because of macroeconomic factors.
Let's just mention hedge funds because this is another one that I think people can understand what a hedge fund is by reference to their public security counterpart, so to speak. Is if you know what a mutual fund is a fund that's operated, it's actively managed by an investment manager, and he says, I'm going to invest in a basket of stocks on the S&P 500, or they'll define the specific exchange that they're going to be focusing on, or a specific class of stocks, by reference to their capitalization size or a sector or segment of the economy. And so the idea is that we're not investing in a single company with the mutual fund, we're investing in a basket. So they may say, we will not hold more than 5% in any one position, so that there's going to be significant diversification there with the mutual fund. And that's the argument for why a mutual fund investment can be good, is that you're diversifying your risk. You're not putting all your eggs in one basket. And a hedge fund is really a private mutual fund. It's a private fund where the manager is going to tell you the same thing. We're going to be investing in this class of stock, but the hedge aspect of it is the traditional hedge funds. The managers would not only place long positions, but they would also make short trades. And the idea is if the long positions where you're expecting profits from the appreciation in price of the security, if your positions there aren't resulting in profitability, then the short positions allow you to make money off of decline in value of securities. And so you can have these offsetting positions that ideally will smooth out returns. And even though you may not participate in all the upside of the market, you're still with that hedge aspect of it, you have consistent, but maybe lower gains over time than you would with the extreme volatility, the ups and downs of just an investment in the market without any hedging. And the idea with them is reduction of risk ideally. they're sort of esoteric in the sense that there's lots of different hedge fund strategies. There's long short equity. There's credit alternatives, and they're really probably the place where, I mean, along with private equity, really be careful with investing and make sure you get to know the investment manager who you're investing with in the hedge fund. And we had a great talk with our friend Larry Powell, who gave us some good insight into how to evaluate an investment manager from a qualitative standpoint. But just we'll include the hedge funds as kind of that last category.
Okay, so just to summarize for everybody, these three main classes or categories of private investments, so private securities and the types of investments that you can make with those, is our private equity, which we've just discussed, and also hedge funds and real estate. So again, private equity often is you're putting capital into a company to help it grow. You might exit through a buyout or an IPO. And private equity is common. It's also venture capital is a form of private equity. Then with hedge funds, Roland just summarized well the investment strategies of the long game and the short game together. There are other limitations on access potentially, and also, being able to take your money out of such a fund. This is an issue with all these classes. And then, of course, commercial real estate is something that has become very popular for an entry into, the world of private assets and private investments. And it's very stable because it's got real property that underpins it. Anything else you want to add for commercial real estate, Roland?
Well, I think the point that you made, that really why I feel good working in this area of sponsoring or representing sponsors of private investment deals. For sure, value can be achieved through the private equity and the hedge funds, but the real estate, the return profile of the commercial real estate is really worth noting that it has by quantitative measurement, and this is an investment management term, a Sharpe ratio. It measures expected returns against the expected volatility, and it's measuring the risk-adjusted return. So, everybody wants to make an investment in the thing that will yield the greatest return with the lowest risk. And if you want to know what category that is, historically, private commercial real estate investments have had the best Sharpe ratio, the highest risk-adjusted returns that you can get in the marketplace. So that's why I really feel, like as an attorney representing issuers of private securities that invest in commercial real estate, I feel good about what I do because I think that we're helping create real value for investors.
Exactly. Yes, exactly. And there's so many of our clients who have been very successful with commercial real estate. And something I admire about them is that they really emphasize wanting to teach the community, teach others about how to build success through the stability of investing in commercial real estate.
Yeah, that's right. And it's just, you said the key term there, commercial real estate. It's set in a community. We drive around and we see the apartment complexes or the office buildings or the single family homes, but all of those make up a specific geography, and all the people that live in that geography, they interact with all that real estate, and there's a community there, and understanding the community effects, that gives you insight into the economics.
Exactly. And I think also something about our clients in this space, a lot of them care about their communities, and they're an aspect of their investments are to improve, the office space and the potential homes for people in the community. So just to finish, Roland, though, we had some other topics to discuss, but maybe we should conclude this episode just mentioning that there are two other classes of investments that are commonly done through private securities, and that would be oil and gas, which is also called energy. But we really include that as a subcategory of commercial real estate because of the way that the law works in that particular industry is really together with commercial real estate. And then also there's infrastructure, which is a cross between real estate and private equity, I guess, conceptually.
Yeah.
So those two classes are still there, and we will discuss them in our webcast over time as specific categories. But they do fit into these other main classes that we like to mention to help people keep all the options they have in private investment, area sort of organized, you could say. So is there anything else you want to talk about, Roland, or should we go ahead and conclude?
No, it seems like that's a good place for us to wind up. We want to try to create a little shorter time together today, just covering this some of the first principles, define the terms. And so I think we've done that, really trying to give a good overview to people about what we're talking about here.
Exactly. I'm really pleased with how this went, Roland. So thank you to everyone for listening. And if you like this episode of Alt Investing Made Easy, please like, subscribe, and communicate with us. One thing we wanted to start mentioning is that if any of you are interested in further information, Roland and I are both attorneys. We work for a law firm called Grable Martin, PLLC. It's a Texas-based law firm, but we work with clients all over the country. And we are available for short consultations in the event that you have any further questions or would like to be further educated about any of the matters that we discussed in here in this webcast.
For sure. And our contact information is found in the show notes, as always.
Exactly. So thanks for joining us. And Roland?
Okay, yeah. Remember, everyone, take aim with your alternative investment strategies.
See you next time.